Hi, I'm Mike Gassewitz, CEO of TriCert Financial Group, and welcome to another episode of InFocus, a special episode. This is a webcast having a look at our investment outlook. And joining me is Brian Durno, our Chief Investment Officer. Welcome, Brian.
Thanks, Mike. Great to be here.
Great to have you on. So, folks, as always, what we do here is we're going to step through some slides. And for those of you who are only listening to the audio, if you have a chance, it would be great for you to have a look at some of the material we're presenting. But if you can't, don't worry about it, and just stay focused on whatever you're doing. But we'll do our best to describe it with audio. So with that, why don't we jump into it? We're looking at things from a macro perspective, and with Trump, a lot of things are in the news, but obviously he talks about interest rates and the Fed, and obviously the changes coming down the pipe. Who is the Fed? But yeah, why don't here we're staring at the difference between central bank policy rates. Why don't you talk us through this one?
Sure. Yeah, and it's always good to start with the macro to get a top-down look before we dig into the details. So what you're looking at here over the last, let's say, 10 years or so is just the connection between the U.S. Fed and the Bank of Canada and the central bank rates. And you can see, over the most of the decade, they're really, really tightly correlated because they both obviously have very similar objectives. And the inflation rates generally were reasonably stable up until the last little while. And you can see this sort of divergence. If you look back, let's say in the fall of 2024, there was pretty much a wide divergence that started to occur where the Bank of Canada was cutting rates more aggressively than the US. And so we've paused now. The Bank of Canada has paused now for the second time. And probably likely to stay on hold for most of the year unless some significant data changes between now and then. And the U.S. also paused in January, taking a bit of a breather, waiting for more data to accumulate. And I would argue that probably the likelihood of the markets pricing in a couple of more cuts from the U.S. in 2026. But there's a lot of asterisks in the data these days.
For sure. Actually, since we're talking about it, any thoughts, opinions on the selection of Mr. Warsh as the next Fed chair?
Yeah, well, that might be a whole nother webcast.
Okay. Yeah.
There's a lot to unpack there. At least I can say there's been a lot of discussion about that choice, and he still has to get the final approval. But there's been a lot of conjecture about what kind of person he is and what to expect from him, and it seems to me we have to wait until we actually see the data. And I think because he has experience at the Fed, is likely to still be very tuned in to the data rather than just sort of executing things a little outside of the normal playbook. But we'll have to see. The jury's out until we see his first starts of movements.
For sure. All right, so talking about central banks, and obviously one of their major mandates is managing inflation. So again, just seeing what's happening here between Canada and the US.
Yeah, and you can see this as we decided to look back at the core inflation rate, which is the blue line. The core inflation rate in the US is the blue line, and the gray line is the core inflation rate in Canada. And you can see, even the 10 years prior, they stayed pretty tightly correlated, just like the central bank rate. And then in November, where that yellow line is showing you that divergence there was relatively material, like the difference in inflation rates. The US inflation rate was pretty much double what it was here in Canada. And since that time, we've been kind of heading the opposite directions. And now we actually have core inflation in the US a little bit lower than what we're experiencing in Canada. So that's something that we've been sort of observing, is this tick up in the Canadian inflation data.
Leading to unemployment?
Yeah, a very important metric, obviously lagging in terms of its usefulness, but it's definitely a good indicator of let's say what's happening to the average person out there. So actually we're showing 6.8 there in December. The January number just came out before we released all these slides, and it's moved down to 6.5% in Canada. That's the gray line. But it's interesting that the jobs rate actually declined, but we lost jobs in the month of January. So there was basically what happened was the labor force and the participation rate changed. There was a reduction in the labor force and the participation rate. So that made the unemployment rate drop, even though we lost jobs. So a very unusual sort of thing to happen in the same month. But you can see, you know, we hit a low of 3.4%, or sorry, 4.8% in Canada back in the summer of 2022, and it's sort of been percolating up. Nothing like super steep there, like you'd see in a recession, but still sort of plodding along the wrong direction. The US hit a low of about 3.4 back in 2023, and is still relatively low at 4.3 now, but a little bit higher than what it was in 2023.
It's good to look at the macro level. So now let's look at it, you know, a little bit more closer to home. You know, even our clients' portfolios and a bond ladder. Like, what are interest rates looking like? Yields looking like? Sorry, for between corporate bonds and government bonds.
Yeah, and this has been relatively stable for the last year and a half or so. The rates haven't changed significantly in the let's say the medium term and the longer end of this little ladder curve, but they have changed a little bit in the 1 and the 2 year because of the central bank cutting rates in the last 18 months or so. So that's where you've seen most of the action on interest rates. And if anyone is thinking back in the older days, a few years back when you could get 4s and 5s, those days are kind of behind us. It's very difficult now to find anything in the 5s. You're looking, you know, say 3.5 for corporate bond. These are high quality investment grade corporate bonds in the short term. And that compares to government bonds around, you know, 2.9 that you're looking at there at the longer end. Still sort of above inflation rates, which is good. You're being compensated for inflation, but not as high as what we saw a few years back. And
Right.
that, maybe I'll mention that to you, Mike. It may not be immediately obvious there, but the spread, if you take, let's say, that 2031 graph, the spread between the corporate bond rate and the government bond rate, basically the premium that you get paid by lending your money to a high grade investment grade company, is only 0.78%. So historically, that's relatively tight in terms of the spread that you're earning. Still attractive, but tight relative to historical norms.
And again, just a reminder to everybody, what we're staring at here, the horizontal axis, we're actually looking at, those are when the bonds are maturing, correct? Yeah.
Exactly. Yeah, the
Yeah.
years of maturity, precisely.
Exactly. Something we don't always talk about, but in the income producing side of our clients' portfolios are preferred shares. So talk to us about, you know, what are we seeing on the preferred share market?
Yeah, this is a spot where you can go to try to find a little bit more yield than what's available in the government bonds or the corporate bond market. And with government bonds and back into the 2s, this is a category that can yield a little bit higher, a little bit more risk than a government bond, of course. But you're being compensated at rates that are, as you can see here, closer to the 5s and 6s in some cases. And because these are preferred shares, they pay out dividends, which qualify for the dividend tax credit in Canada. So it makes this form of income not only a higher yield, but also very tax efficient in non-registered accounts. So that's just something to keep in mind in portfolio construction that we look at all the time.
That's extremely important. Again, back to this, you know, I always think of a preferred share almost as a hybrid, right? But so in terms of it's actually paying a dividend, so after tax, they tend to yield even more.
Exactly.
Okay, this next slide I always found, you know, there's a lot on this slide to unpack. Big things in 2026. A lot going on. I mean, I guess you can say that in any year, but it just does seem like there is a lot happening.
Yeah, boy, if there's ever an appropriate time for an etc., it's right now. I find when I'm using AI, they don't use the word etc. very much. And this is one of those slides where even AI may have been incented to use an etc. But there's many, many things. We won't go through them all in detail. The big one, obviously, that catches most of our attention here in Canada is the renegotiation of the CUSMA or the USMCA, the free trade agreement in the summer. We'd expect there to be lots more headlines and saber rattling and let's say unusual and unpredictable headlines that could cause volatility in markets. We've been actually pretty conditioned to some of these headlines and tend not to react. at the portfolio level with against any of these sort of movements, but we're definitely trying to track the fundamentals and the consequences of some of these things you see on the slide. And I can say at the end of this, all of these things listed here on this slide, diversification still works. It is still a free lunch, and in spite of the fact that it has its ups and downs, the idea of being diversified is still a very, very smart thing to do.
So let's bring it to GDP and the growth rates.
Yes, I circled for you on the slide there just to, it's hard, so much has happened in the last year or so. Just to show you last year, the red parts of the GDP growth. Canadian GDP growth is shown in the gray line, and US GDP growth is shown in the blue line. And earlier last year at this time, actually both economies had contracted a little bit. So that was something that caught a lot of people's attention and started to increase people's bets on there being a recession. And I just thought it was very useful to notice how fast both of the economies sort of snapped back from that funk they were in the very first part of the year. The only thing I might mention, in spite of what I just said, the Canadian data was just released, the preliminary data for December, and for Q4 that is. So that was the quarter ended December 31st. They haven't released the final numbers, but it looks like there could be the potential for a small contraction in the Canadian economy in Q4. So even though you're looking at a pretty healthy looking line there in the gray, that probably will take a dip down here in Q1. In the US, on the other hand, it's still percolating at much higher levels. Even GDP now, which the Atlanta Fed updates these numbers pretty quick, they're running around 4.2% or so at the current level in Q1. So it's been, let's say, much more resilient than many people would have expected.
Politics aside, it is interesting to see, despite all the turmoil that the man may cause, the economy still seems to be humming along just fine south of the border.
Yeah, there's been a great bunch of demand created by the AI capital spending by the hyperscalers that have done a remarkable job at supporting some of the growth rates in the U.S. economy.
Yeah, so that's GDP. Let's bring it to the equity markets, and I know you guys obviously keep a lot of track of a lot of factors. A bit of a scorecard here. What are we staring at?
Yeah, this is a good way to just sort of summarize let's say, the three most important things that underpin the equity market health. Is sort of a reasonable way to just kind of look at the major factors that are driving equity markets. So this is the three things that we think are very, very important, and we sort of color them green for pretty good, and yellow for cautious, and red, of course, for not so good. And so on the corporate profit front, we're going to talk about that in a few minutes here, but it's been much more resilient and stronger than anyone would have expected. We're talking double-digit growth rates in corporate profits, which is very, very healthy. So that gets you a green. Inflation, interest rates, and fiscal policy as a collective kind of gets you green. I might argue here the fiscal policy in the US, we're still running roughly around 6% of GDP as a deficit in government spending, which is a tremendous amount of stimulative effect in the economy. Canada's around 2.5%, not quite as spending than the US, but still stimulative in its nature. So that's been sort of a backdrop of, let's say, tailwinds in the economy. Valuations is the only part where we felt a little more yellow, a little more cautious about things, and that's primarily in the US. And even there, you'll see it's in just a few pockets that's been much more challenging to find cheap bargain stocks.
So tariffs, the T word, and could be taxes. That's also a bad word, but tariffs, are they showing up in the margins in terms of companies and what they're reporting?
This is something we decided to start tracking sort of at a high level, and we use the S&P 500 as our proxy here, just to see what effect tariffs might be having on the actual bottom-up companies rather than the headlines that we're seeing on the macro side. And so far, you can see that the very final bar is Q4 being reported right now. We're about 2/3 of the way through earnings season. So it's not a final bar, but it does look like so far the margin levels in the US are sustaining themselves at very high levels in spite of the tariffs and all the various, let's say, overhangs that have been in the economy the last little while. So margins are still pretty healthy. There's something that's not on this slide, though. I figured I would just mention the average cost. There's been some work done on the average cost to households in the U.S. from tariffs, and it's very difficult to pin this number down. So I wouldn't want to say that it's a perfect estimate, but it's done by very, very reputable economists at Harvard. Somewhere between $1,300 and $2,100 is the average cost per household of tariffs. And the real hard part about that is the tariffs are sort of regressive in their nature, in that they hit the lower income people worse than they hit higher income, because the $1,300 to $2,100 is relatively indiscriminate. It's across the board, so you're left with a little bit more, let's say, pain at the lower end, the lower income levels.
And I guess that's where, one of the drivers behind, the term K-shaped economy, where you're starting to see the lower income being hit harder than the upper income folks.
Yeah, and inflation, even when you run the series of inflation and you look at inflation since COVID, it's basically food and shelter have grown at a faster rate than the general level of prices. So their inflation rates have been more than the rest of the economies. So if food and shelter is a big component of your household spending, not only are you suffering on that front, you're suffering on the shelter and the food part of the equation too. So that is what's led partly to this K-shaped recovery that you're talking about.
Mm. So corporate profits from a quarterly and annual perspective, the growth.
Yeah, we decided to show you two back-to-back pictures. The one on the left is the quarterly progression. So that's the year-over-year growth rate in corporate profits. So just to navigate you there, that yellow line we drew is basically the 10% growth rate line. So if you look at Q4, the current level of corporate profits growth rate is 11.9. Actually, after this week, it's 13.1. So it's actually improved a little bit this week. But you're talking double-digit growth rate for, it looks like 6 of the last 7 quarters have been greater than 10%, which I think most people would be surprised by that level of resilience in the corporate profits.
Definitely not what you necessarily would have predicted when we had all the uncertainty earlier last year.
That's right. That's what makes this, the business very, very difficult to be reacting to conjecture and headlines all the time. And we tend to stay very, very focused on the bottom up fundamentals of companies, because they sometimes tell a different tale than what you're reading in the press.
And I remember on one of our podcasts with Mr. Dave Gill, an excellent member of your team, and he was talking about that when all this, obviously more than noise, I mean, real fact-based tariffs was coming down the pipe. He said, one thing is to, when he was in, and I know all your team members are listening in on the quarterly calls of the management teams of all of most of our holdings, and you could tell that, these are excellent teams. They're very resilient themselves in terms of how they manage their businesses and how they're going to deal with these challenges as they're coming up. So it's interesting to see this at this stage. So this is the U.S. perspective. So let's look at things from a Canadian perspective.
Yeah, it's a similar picture of growth rates. We're looking at by 2025, when this quarter is finally finished reporting, you'll probably be running around 11.8 or 12% growth rate in corporate profits in Canada. And the expectations for 2026 are also for about 17%. And that's up from about 14% at the same time last quarter. So let's say the momentum in corporate profits is still kind of clipping along here in Canada. I might mention one asterisk, though, on the Canadian data. A lot of the growth rate that we've seen in the Canadian marketplace has been very narrowly focused on the materials sector. That sector had about a 91% move in the last 12 months or so. It was very unusual for one of our entire sectors to move by 91%. And if you look at why that's happened, about 124% gain in gold as the sub-index in that materials is responsible for a big chunk of that gain. So 124% gain in gold led to a 91% gain in materials. And as a result, now materials as a sector in the Canadian-based market is roughly around 20% of that whole index. So that's another feature where if you're just looking at the headline TSX number, unless you had a healthy weighting in gold and materials, you probably didn't have that same level of performance.
And that spike in gold is not necessarily a good news story. Am I right?
Let's say it was the industrial sector or the consumer staples sector, it would be broadly distributed around the economy.
Right.
And whereas here it's more of a financial asset, the price of gold has gone up materially. So, which doesn't necessarily produce more jobs and more spending from the average household. It's kind of a narrow, if you owned gold, you're feeling much richer. Whether you've gone out and spent it is another question. Whereas if it was wage based or something more, let's say, economically driven, it would have more of a trickle down effect.
So is the flight to gold, driving up those prices, that's not necessarily a good thing, is it? Is this like people flying to, is there a flight to safety here, so to speak?
Yeah, the things that make the price of gold move are confounding and mysterious and complicated. It's never really quite as simple as, it's a great inflation hedge. There was a period where negative real interest rates was the correlative factor. Inflation was a correlative factor. Fear was a correlative factor. It tends to move around with very unpredictable features to it. So it's hard to pin down. And even central bank buying creates more demand, and the supply and demand imbalance starts to play. And then you have momentum and speculative excess and these kinds of things that play into it. So to parse it out with gold is very difficult. Companies, it becomes a little bit easier because you have corporate profits. You have competitive
Right.
advantages that you can, let's say, understand, which makes it just a little bit easier to model.
So it's not simple. That's what you're saying.
It's not simple. I was trying to be kind
Yeah,
about it.
you're
Yeah.
being polite, but
Yeah.
I appreciate that. No, yeah, a lot of factors at play. One of my favorite slides. I love looking at this every quarter. And so why don't you walk us through this?
Yeah, this is something we look at all the time to help us sort of find which shopping aisle to go down to look for bargains. It's a way of looking at the market. This in this case is the U.S. market. It's the simplest one to look at. So we have the red line down the middle, which is basically the S&P 500 multiple of the market. So anything to the left of that line is cheaper than the market. So that's one thing to notice, first of all. So everything to the left is cheaper than the market. Everything to the right is more expensive than the market. Being more cheaper or more expensive doesn't necessarily mean it's actually cheaper or more expensive. Just means the multiple's lower, and so you still have a ton of work to do to determine if that valuation makes sense. But it's useful for looking for cheaper stocks. The green line is each of those sectors how it's trading relative to the market. Is it cheaper relative to its 30-year average against the market? So if a sector usually trades at a premium to the market, but today it trades at a discount, it would show up down in the left quadrant. And so we kind of isolate that left bottom into the left quadrant as all the sectors that are cheaper than the market and cheaper than their historical 30-year average against the market as, let's say, opportunities to just go walking down those aisles to see if there's some stocks that are, left behind and not trading at expensive multiples. And that is how we found one of our more recent healthcare stocks that we added to our core pick list. And I guess the bottom line of this graph is, in spite of the fact that valuations in the U.S. are challenging and it's widely discussed out in the marketplace, let's say the absolute level of U.S. valuations, there are still pockets of very interesting things when you take a sector-based view of things.
Exactly. Back to the QSECT approach. I like this in terms of understanding from our core picks perspective, what is our dividend track record?
Yeah, and this is one of those, your investment process right there in a nutshell. Like when you invest in companies with an ROE or return on invested capital that's higher than their cost of capital, they generate cash that can be used to pay a dividend, to grow their dividend, to pay down debt, to do M&A, do all kinds of fun things with the capital. Getting capital returned to shareholders is one of those things. And so it's a symptom of a pretty high quality business when you can pay a good dividend that grows over time. So we like to use this as kind of evidence of the symptom of higher quality businesses. And the growth rate in dividends, you can see pretty consistent over the years, even during bad years like 2015, 2018, 2020, 2022, 2025, all had significant market corrections, more than 15%. But the dividend track record still kind of clipped along there. 5 and 10-year averages are much higher than the levels of inflation. So your income kept pace with inflation, which is exactly what you want to see.
Yeah, I just always find this powerful because this is the increase of the dividends. This is again back to the testament of what you and the team do in terms of the core picks. And again, always good to track this in terms of just really telling the whole story in just a few statistics of the QSect approach.
Yeah, we figured we'd show it to you with the back of one of our, we have an equity pooled fund that we use here at the firm, and we just took a nice average of, let's say, the high level metrics and compared them to the Canadian and US markets represented by the TSX and the S&P 500. And you can see the ROE, sort of the return on equity, the hallmarks of, let's say, value creating companies, a little bit higher than the average, well, materially higher, I'd say, than the average between Canada and the US. The dividend yield was higher. You can also see our growth rate in that prior slide has been pretty strong over the years. The beta, let's say, is a relatively simple measure of, let's say, sensitivity to market movements. You can call the beta a little bit less volatile than the market, 0.76. And the forward PE, the simple average was 18.4 compared to the markets at 19.8. And then I realized, of course, the markets are market cap weighted. So the weightings of those holdings certainly have an effect on that 19.8. So I decided to market cap weight, pool weight our PE ratio of the pool's holdings. And that would be 16.1. So just cheaper than the average stock inside of the S&P 500 and the TSX.
I love this. I do this every time, and I'm going to do it again. Back to the approach, we're looking for companies that have a higher return in terms of the return on equity, the dividend, pay a higher dividend back to the shareholders, less volatile, and cheaper than the market. And if you stick with that approach for the long term, clients tend to be in good shape when that happens. So Brian, thanks for this. I guess, in summary, the economy, the markets, the companies, they're all doing okay. They're doing just fine.
You definitely don't want to take your eye out of the windshield, but it's one of those things where we, it's a hard market, and it's definitely important to stay focused on all the changes that are happening out there and in analyzing them through the lens of the portfolio that we've built for clients.
And that always makes me glad talking to you and your team. It's good to know that our clients' portfolios are in great hands. So Brian, thank you so much for this.
Excellent. Thanks for having me, Mike.
Folks, as always, if you have any questions, don't hesitate to reach out to your TriCert Investment Counsel Portfolio Manager or your advisor at your CPA firm, or don't ever hesitate to reach out to myself. Take care.
This webcast is provided for informational purposes only and does not constitute investment, tax, or legal advice. The information is current as of the date of the webcast and may change without notice. Any investments and/or strategies discussed may not be suitable for all viewers and should be considered based on individual investment objectives and circumstances. Past performance is not indicative of future results. Viewers are encouraged to seek advice from qualified professionals before making any financial or other decisions based on this webcast.